Okay, start recording. Alright.
Can you see my screen?
Yeah, you're good.
Okay, alright. Okay. Yeah. So I think I got disconnected when I was doing. Oh, God, that's a lot. Okay. It was somewhere here. Then here. Is this the last thing you guys saw?
When you got to 2400 and then you found the PP1, that's where we ended.
Right. Okay, cool. So yeah, what we do is for principal payment 1, you just take A and you subtract by 1. It was 8326, like we calculated right here. Then minus 2400, so you get 5926. Then what you do is you find the balance after the first year, that is B1. For that, you do B0 minus principal payment in the first period. So 20,000 is the initial balance right here, minus 5926, the principal payment, which gives you 14,074. Okay. Now the debt investment, the debt interest in the second period, I2, is 14,074 to 0.12, that is the interest rate. You get this by the formula Bn minus 1 into I. Okay. Then 2 equals to 1689 based on this. Okay. Then you calculate the principal payment in the second period. So for that, what you do is A minus I2. A is again 326 minus 1689. That is the I2 that we found right here. So you subtract that and you get the principal payment in the second period. And then find the balance after the second period. So the balance after the first period was 14,074, right? Here. Okay. What you do is you take the balance after the first period, subtract the principal payment, and you get the balance after the second period. So after you get the balance after the second period, you can calculate the interest that you paid for the second period. To do that, again, the formula is the same thing. Bn minus 1 into I. So you get 892.44, but then in chapter 14 and 8, we're just going to be using whole number values. So it's going to be 892. Okay. Then to calculate the principal payment in the third period, you're going to use again A minus I3. A is again 8326, and this is 892.42. You do that, you get 7433.5. You round it off to 7434. Right? So by doing this, we're going to be filling 2 rows in the main table. I'll show which rows we filled according to this. To be honest, I'll just erase this and go over it again. Okay. Yep, we had done so CCA. Okay. So yeah, we got the interest in the first period right here. It's 2,400. The interest in the second was 1689, and the interest in the third one as 892. Write those in this debt interest row right here. This one, you get all 3 of those: 2,400, 1689, and 892. Then you got the CCA already. Okay, and then one more thing we can fill using what we did here is the principal payment values. The principal payment in 1 is 5926. Principal payment in 2 is 6637. Principal payment in 3 is 7434. We go back here to principal repayment, this one. and you fill it up with 5926 6637 and 7434. The reason I'm putting this in brackets is because this is the amount that's going to be going out from the company's account. This is the amount they're paying, and all the amount that you're paying is going to be in brackets. Okay. Also, the borrowed funds is how much we are borrowing from the bank, and right here it said no, not this one. Okay, it said that we're going to be using purchase 50% on debt. So 50% of the initial amount, that is 40,000, is going to be 20,000. So that's how much we're borrowing, right? That's how much we took right here. Here we go. The P, we took it as 20,000. That's what you just put there, okay? The borrowed funds, 20,000. Okay. This is not something we're paying. This is something that we got, so it's not in brackets. Right. Let's go back up here. Now we need to continue filling the income statement. So the taxable net income. So what we do for this is add all this. For the taxable net income, I just wrote it here. Taxable net income is calculated by revenue minus expenses. So you take the revenue. Wait, I'm still on, right? You guys hear me?
Yeah, no worries. You're good.
Okay, good. Right. So the taxable net income is the revenue minus the expenses. So revenue in the first column is 33,000, and then the expenses are going to be all this. You take 33,000 and you subtract minus 13,200 minus 2,400 minus 6,000. So you get 11,400. Here, okay, let me change the column. 11,400 as your taxable net income. And in the second period, you get 36,300 minus 1490. Well, I'll just copy it over because it's the same process. Here, right here. Taxable net income. So take this, you subtract all this. Okay. So you get, what do you get here? 9891. Then same thing for the third one. You take the revenue, 39,930, and you subtract all this. You get 15,926. So now, after that, we're going to calculate the income tax on the taxable net income. So income tax, the rate has been given to us as 40%. Right here. That's the rate of 40%. So take 40% of these values we got right here. So 40% of 11,400 is going to be 4560. 50% of 9891 is 3956.4, but then we just take it as 3956 because if we get a 3956.4, but then we just drop the last one. Okay, then 15,926 into 0.4, 6370.4. 6370.4. Again, you drop the point because it's less than 5. Okay. So this is the income tax. So now the main thing that we need to calculate in this, the income statement, in this table, is the net income. This row. This is the main thing. So to calculate the net income, what we do is take taxable net income, this row, you subtract the income tax. 11,400 minus 4,560. See what we get. It's 6840. Then in the next one, you get 9891 minus 3956, 935. Then in the next one, you get 15,926 minus 6370. Get 9556. All right. Just check. That's right. This is the net income. This, doing this much, concludes our first table, the income statement. Now we move on to the cash flow statement, and the first two rows for this are pretty simple. Net income is just going to be copying what we were above, 6840, 5935, 9556. Okay, and the CCA, it's again copying from the top right here. CCA row, you just copy that. 6,000, 1,200, and 7140. All right. So this way you get the first two rows. Now you need to calculate the next one is the investment. So the investment was $40,000 right here. Okay. And this was something that went out of the company's account. So we're going to put this in the brackets. Next is the working capital. So they talked about the working capital, right? Where was it? Assume the firm also requires working capital of $4,000 contained in purchasing power. What we're going to do is with working capital is in n equals to 0, the working capital is going to be 4,000. Did I explain earlier what working capital was, or was that?
Just the debt part.
Right. Okay, I'll just say it again. So the working capital is basically like, suppose that you go to a restaurant, you see a waiter, right? So they're gonna have this pouch where they carry the change, give the customers. So that is like the working capital of the restaurant. That is something that's used on a daily expense, on a daily basis. So the company does not get any return for that. You cannot, put that in a bank because that's going to be being used on a daily basis. They're going to use it and they're going to get it back on a daily basis. So that is the working capital. So in the first n equals to 0, it's 4,000. Then I'll erase this and do it again. Okay. N equals to 1, the working capital is going to experience inflation, right? So the general inflation rate was 10%. So n equals to 1, the working capital 1 is going to be 4,000 into 0.1. That is 400. Okay. That is the amount that should be added by the company to keep the working capital at the actual dollar rate. Okay. Next, for the n equals to 2, the working capital again, you take it from the working capital 1, take the 400, and you get the 1.1 multiplied by the inflation rate, you get 440. All right. So now for n equals to 3, you can find the working capital. This is the last period, right? So you can find the working capital as 440 to 1.1 again. This would be 484. But then the thing is, they said that the working capital is going to be recovered right here. It will be recovered at the project's completion. And n equals to 3, the whole working capital is going to be recovered. So what it would be like is that at n equals to 3, the working capital use would be 484, and then the recovering part would be all this from the 4,000. Okay, so it would be 4,000 plus 400 plus 440 plus 484. All this. Okay, so it would be something 5,300. Let me do it again. 4,000 plus 400 plus 440 484. Get 5,324. Okay. But then the thing is, this annual working capital and the recovering part are in the same period, right? So they're just going to cancel each other out. So instead of putting the final working capital of n equals to 3 there, you can just leave it out and do the working capital till n equals to 2. So that way what we get, the recovering is 4,000 plus 400 plus 440. This, you get it as 4484 if I'm not wrong. Let me do it again. 1,000 plus 400 plus 440. 4840, no mind. 484. Okay. This is what is going to be recovered at the end of the 3 periods. So we got working capital in the first n equals to 0. It is 4,000. And this is something that the company is going to be paying every day to, to get used up on the daily basis. Then in the next one, in n equals to 1, it was 400. In n equals to 2, it was 440. It's negative, so it's in brackets. And what is being recovered is going to be positive because the company is going to get that back, right? Not giving that. So this 4840. Okay, that's done. Now the salvage value. Right. Let me clear this. Okay. The salvage value. So what they gave as a salvage value right here. Where did they give it? Here. $5,000 salvage value. Get 3 real life and $5,000 salvage value. So the salvage value is going to be $5,000, but this is in constant dollars without the inflation. So constant dollars. So in our table, we got everything in actual dollars. So we need to convert this to the actual dollars. To do that, take the constant dollars and you add the inflation rate. 1 plus F in n equals to 3. The third period, the salvage value is going to be at the end of the project at the third period. So you raise this to 3. Okay.
So salvage is always constant, right? Like if he tells us the salvage value.
Yeah, if they tell us the salvage value, it's always going to be in the third period, but then you're going to need to inflate it. That's what I'm doing right here.
Yeah, okay, that makes sense.
So 5,000, and then the inflation rate here, it's 10%. 1.1 raised to the power 3. This is how you get 5,000 into 1.1 raised to the power 3, 6655. Yeah. So you write that down in the third period right here. 6655. Okay. Finally, we need the disposal tax effect. Okay. All right. So, like we said earlier in Chapter 8, to calculate the disposal tax effect, we need the U final, minus the S, into the tax rate. And now, in this case, we need to calculate U final, which was U3. Find U3. We know that the initial investment was 40,000. Okay. The first period, it got depreciated by 15% because the CCA rate was 30%, but it's going to be half of that. So it's going to be depreciated by 15% in the first period. But then that would be for the CCA. The undepreciated value, it's going to be 0.85 because that's what would be remaining. And in the other, this is the UCC 1. Then 2 and 3. In the second period, it's going to be depreciated by 30%. So what's going to remain is 70%. And then in the third period, it's going to be depreciated again by 30%. So what's going to again remain is 20%. Do this and get the answer as 40,000 into 0.85 into 0.7 square. 16,660. 16,660. This is the U3. Now to calculate the disposal tax effect, you get U3 minus S into T equals to 16,660 minus 6,655. That's what we calculated right here. Then you multiply this by the tax rate. The tax rate is given right here. That's a rate of 40%. So 0.4. Okay. So you get this as 16,660 minus 6655 and 2.4. That is 4,002. That's the disposal tax effect. All right. Now, one thing to keep in mind here is the U3 we got was greater than the salvage value. What that means is the equipment was under depreciated. So the company ended up paying more in taxes than it should have. So the company paid more. Paid more than it should have. Right? So what that means is how much did they pay more? They paid $4,002 more. So the CRA is going to give this back to the company since it's positive, all right? So the U3 is greater. In case if U3 would be lesser than S and we would get the answer, the TTE as minus 4,002, that case, what it would mean is that the equipment was over depreciated. As a result, the company paid less taxes. So the company would have to give this amount, the CRA. Again, yeah, I was just explaining this. So in this case, we got 4,002. The CRA would give this to the company. Also, they wouldn't literally give this by a check or something. They would just deduct this amount from the income tax. Okay, that's how you get the disposal tax effect. 2002, right here. Okay, now we already got done with this, right? These principal repayments and the borrowed funds. Yeah, I just said this too. Okay, 1,000. Now this way you get done with the cash flow statement too. Now we come to the end of the cash flow statement where we would be calculating the cash flow in actual dollars. So to do this, you just add everything up in this cash flow statement. Okay, my bad. Right here, you add everything of this up. So this 40,000 and 4,000 are negative and 20,000 is positive. So when you add this up, you get negative 24,000. Okay. Then here, you just add this up. Let me do that. 6840 plus 6,000 minus 400 minus 5926 6514 and 935 10,200 minus 440 minus 6637 9058. Okay, and in the final one, it's 9556 7140 plus 4840 plus 6655 plus 4002 minus 7434. You get 24,759. Right. This would be the final answer of the net cash flow in actual dollars. You're gonna need to calculate it in constant dollars too, but then we'll do that in a minute.
By the way, your principal repayment, was that just the PP part?
Yeah, it's just the PP.
Okay.
PP1, PP2, and PP3. So right here, PP1 is 5926, PP2 is 6637, and PP3 is 7434. That's exactly what you copied on here. 926, 6637, and 7434.
Yeah, it makes sense.
Also, one thing I noticed in the solutions is I think he messed up this part right here. If you see the net cash flow in the first period, it's 6154 what he wrote. Then I tried like adding this up, and when I got disconnected, I didn't realize, and I was just adding this up again and again. So if you add this up, see 6840,
It's gonna be 6,500.
6,000. Yeah, it's gonna be 6514.
Yeah, he messed up.
Yeah.
The 5 and 1.
So this is what you get as the net cash flow in actual dollars. So does anyone have any doubts till this point?
Don't think so.
Do we got people, or is it just you and me? So
No, there's people here. It's just nobody that I guess
Right,
nobody
right.
talks.
okay, cool. Wait, I'm just gonna come back in 1 second.
Yeah. Just don't disconnect that. Okay, he's still here. Good. Recording is going.
Okay. The next thing we need to do is we need to calculate the net cash flow in constant dollars. So, thing about actual dollars is, like I said earlier, it's gonna include inflation. So we need to find out constant dollars without the inflation. So to do this, what we do is we take the actual dollars and then we deflate it. You get the constant dollars. Okay. So to deflate something, what you need to do is take each of these values and then you use this formula right here, all the way to the top, right here, deflate. What happens is this is the constant dollars. This is the this is the constant dollars. These are the actual dollars that we found in the table at the end of the table. And that is the okay. This is the general inflation rate. And this is the period to which it belongs. We use this formula and we calculate the constant dollars of each of those values. All these. Where is it? These 4 values. Okay. 24,000. Let's start with 24,000. Okay. So the first one, A1 equals to 24,000 into 1.1 raised to the power minus 1. It's in, oh, okay, never mind. This is in the 0th period. So it's going to be the same thing. Minus 24. Okay. But now minus, I'm already putting the bracket. So 24,000. Okay. Second one, 6514. It's in the first period. So this is A0, A1 equals to 6514. 1.1 raised to the power minus 1. You do this, 6514 divided by 1.1, get 59. What am I missing out? 595. What did it do? Oh, he calculated that also. 6154. Yeah.
If you want to email
Yeah.
him after on that.
Yeah, okay. I'll do that.
Yeah,
6514 divided by
you're right
1.1.
Yeah, you're right on
Okay, so you get it as 5921.8, which you can just write 5922. Okay. Then A2. A2 is what? A2 is 9058. So 9058 into 1 and 1, but this time it's in period 2, so it's 2. 9058 divided by 1.1 raised to the power 2. Get 7485.9, which again you need to write as 7486, which is what you got, so that's correct. Finally, it's 24,759. 24,759 to 1.1 raised to the power minus 3 equals to 24,759 divided by 1.1 raised to the 3. 18,601. 601.8 equals to 18,600. So that is what we copy all the way up. 18,602, 7486, and 922. 922. This is the net cash flow in constant dollars. Okay. Now we need to find the internal rate of return. Let's see what the question asks. Is this spot till here? Everything's going to be the same that you're going to do for everything. Okay. So the question's asking, it has like 5 parts, six, no, 7 parts. Never mind. Number 6 is asking disposal tax effect in actual dollars. DTE, we calculated that already. Right here, disposal tax effect is 4,002. The answer for this is 4,002. Seventh. Seventh asks the CCA3 of the project in constant dollars. Okay. Now, this CCA is in actual dollars, 7140. So what they do is CCA3, what we got was 7140. But to get CCA3 dash, that is the constant dollars one.
Isn't CCA always in constant? Because you don't apply inflation to it.
Right, yeah. Never mind, my bad.
Yeah. So you
Let
got it
me
already.
just check.
Just check that because.
But he's dividing it.
That's weird. Yeah, because in the slides, I think he said that.
Yeah, I remember too. He said that CCA is the only thing that won't experience any inflation. I said it earlier, right? Yeah, I think so.
I
So
guess.
I don't know why.
Yeah, I guess it is in actual dollars. I don't know.
I think this goes to, or maybe he messed. I don't know. I guess we'll just do it. Okay, 7140. Let's just assume that CCA also undergoes inflation. Okay. The way I'll email him and ask him what's wrong. Oh, one place. Yes. This is in the third period. Oh, -3. No, it's -3. You're deflating it. Yeah, so -3. And the inflation rate was 10%, so 1.1 raised to the power -3. So yeah, you get the 5364.3. Again, we need to just put it off. All right, that's 7th. What was the 8th question? Interest payment in the third year in actual dollars. Right. So like when we do this whole table, is 1 second. Sorry, my bad. Okay. When we do this table, you can just copy down the values after you complete the table. Is basically just writing the answers. So interest payment in the third year, it's your debt interest in the third year, 92. And it's already in actual dollars. So yeah. 3 equals to 892. Third year cash flow of the project in actual dollars. So the final answer in actual dollars is what he's asking. Net cash flow of the third year, 24,759. That's pretty much just copying it down. Net cash flow, net worth, I guess, of third is 24,759. Number 10. Equivalent present worth of the project given mark. Okay. Let's just check till this point. Are we right? 4,759, 892. Yep, that's right. Okay. Now to calculate the present worth, what we do is, now he said present worth given mar, not mar dash. So what we need to do is, we need to find, let's find, okay. So this is where the mar is going to be applied, because this is the actual dollars. This is where the mar dash is going to be applied. So yeah, there was this formula that I don't think I wrote earlier. Calculate the mar from the mar dash. The mar is going to be mar dash plus the inflation rate plus the inflation rate into mar dash. This is the formula. Okay. So using this, we can calculate the mar. The mar dash was what? 7%. So 0.07 plus 0.1 plus 0.1 into 0.07. That is 0.007. Okay. You get 0.177. This is the mar. Now we need to calculate the present worth of the actual dollars. Given this mar. Right. To do that, we do is we need to bring all of it. So it's minus 24,000. 24,400 was it? 4,000. Only 24,000. Minus 24,000 plus 514, taking it back one period. 6514, find P given F. 0.177, one period. Plus, this is the next one. 9058 and 24,759. 9058. Find P given F. 0.177 periods. That's 24,759. And P given F. 0.177 periods this time because this was an N3. Okay. Now this is just minus 24,000 plus 6514. 1.177 raised to the power minus 1 plus 9058. 1.177 raised to the power minus 2 plus 24,759. 1.177 raised to the power minus 3. You plug this in, minus 24,000 plus 6514 into 1.177 raised to minus 1 plus 9058. 1.177 raised to the power minus 2 plus 24,759. 1.177 raised to the power minus 77 raised to the power minus 3. Okay, what I'm getting is 3,057.5. 3,257.5. Okay, so that would be 3,258. Present worth according to Mar. Check if that's right. Is that right? Yep, it is 3,258. Okay. Mar equals to 3,258. So do you guys have any doubts till this point? We're almost done. It's just 2 more questions. Or any of the things in the table. So again, I'm just going to repeat this. The rate they gave us was the mar dash right here. That applies to constant dollars only. You cannot use that for the net cash flow of the actual dollars. Use the net cash flow to use the mar of the net cash flow of actual dollars. You need to find mar, only mar, not mar dash. So you need to find this from this. Okay. So to do that, I use this formula again. R dash right here. It's in the slides. I'll just show you guys where it is. Chapter 14.
By the way, you
Right.
already had constant dollars, so you could have just used 7%. But like, yeah, the way that you showed it is usually, I think, what he told us to do.
Yeah, no, the reason I used mar is because they told us to find mar and not mar dash. So you see here?
But you would get the same answer then, is what I mean.
Oh yeah, I get what you're saying. So you're saying that I could have just used mar and then inflated it, right?
Well, you didn't have to because you already had the constant dollars. If you know what I mean. Like
Oh, but then
you put the whole line of constant dollars, so you could have just used the mar dash.
no, but then they're asking only for mar, right? So you would have to so what you're saying is to find
the PW, you can use constant dollars.
yeah. So what you're saying is to come on, find PW of mar dash, right?
Yeah, but it's the same thing, isn't it?
No, it isn't.
You
PW
sure?
of mar dash is not equal to PW of mar.
But that's what he showed in the slides.
Yeah?
Or in the answer, I think. Just check the answer. Cause like that's what I was thinking originally. You could have just used the constant dollars.
Okay. So what he did, yeah, he did the same thing like what I did. So if you see this, he calculated the mar right here. So
Yeah, right
what did
above
he
that, and
do?
then like after that, that's what you did, and then right above that, he
Oh,
used.
okay, you're getting it.
You know what I mean?
Right. Yeah.
Yeah.
So it's
So
gonna be
it's
different. Never mind.
yeah, it's the same thing. That's what I just wanted to point that out. I thought you see what I
Right.
mean.
You're right. Yeah. It's the same thing. It's wrong. It's equal. Both of these are equal. The PW of mar dash or the PW of mar. Okay. So yeah, you could have done this, what I did, or you could have just used mar, the mar dash. I mean, mar dash was 7%. You could have calculated the present worth of the 7%, and you would have still gotten the same answer, that is 3258.
Yeah.
Okay. Right.
It's good
What
you
is
wrote the
next?
what do you call it, the actual dollars, because it's more helpful.
Yeah. Okay. Anyway, now we need to find out the internal rate of return dash. That is okay. This one, I think we need to use the constant dollars. We need to find the IRR dash. I remember him giving some equivalence when IRR dash was equal to IRR. Let me check if I can find it.
It's the same formula as the mar.
True. Yeah. Okay. Anyway, let's get ahead. So to find out the IRR dash, what we do is this a simple? Yeah, he said that for these chapter 14 problems, it's always going to be a simple cash flow. So if you guys remember in chapter 5, at the end of chapter 5, we dealt with simple and non-simple cash flows. So to find out IRR for simple cash flows, you can do present worth. The I is equal to 0, and you can solve for I. And this is for simple. And for non-simple, you need to do under method of project balance. The project balance given I is equal to 0. That's what we need to project balance in the nth period given I is equal to 0. That would be what we would need for the non-simple one. This is simple, so we can just use this method right here. So to do that, net present, we need to say net present worth I equal to 0. Now the thing is, he gave the window right here, window for IRR dash is 10 to 15%. So we need to know, so we know that we need to calculate in between these. And the thing is, like it's gonna be multiple choice, right? So they're gonna give us the options like 10 to 11%, 11 to 12%, 12 to 13%, or 13 to 14, 14 to 15. These are gonna be our options because that's the window for the IRR. So we know that we need to calculate, we need to substitute for the I in any one of these values. So I mean, I saw the answer, so I guess we could just save time if what we would do in the exam is we would suppose we would just take the centermost value, these two values, now calculate net present worth using 12%. So to do that, it will be minus 24,000 plus, let me zoom out, 6514, 1 plus I raised to the power minus 1 plus, what else, 9058, 1 plus I raised to the power minus 2 plus 24,759, 1 plus I to the power minus 3. So what we're doing here is we're taking all of these values, all that we here, taking all of these. No, not this ones. Taking these ones. Oh, never mind. I think we need to take the other ones, right? IR dash. Yeah, my bad. We need to take these constant dollar values. 922, 7486, and 18602. So 5922. Instead of 6514, it would be 5922. I think it might just turn out to be the same, but let's just take it. 922. And the next one was 7486 and 18602. 7486 and 18602. Right. So now we substitute I as 12%. It's going to be your guess. So what we get is plus 5922, 1.12 minus 1 plus 7486, 1.12 minus 2 plus 18602, 1.1 minus 3. Let me calculate this. 4,000 plus 922, 1.12 raised to the power minus 1 plus 7486 to 1.12 raised to the power minus 2 plus 18,602 into 1.12 raised to the power minus 3. Okay, I hope I got this right. So what I'm getting is 495.8. That would be 496 in present worth. I think. Right. Let me check if this is what he got. He got 204. Probably messed up somewhere. Oh, he. Yeah, never mind. He took the 5595. That's probably why he got.
It's one value that was wrong. It messed up
The whole problem. Okay,
GG.
so this was for 12%.
So you have
Present value for 12%. Okay, this is positive. Now let's try to take. So the thing about present value and the interest rate is that they're inversely proportional. Okay, so we need to decrease the present value. We need to make it equal to 0, right? We need to decrease the present value. So we're gonna have to increase. Let me do this. Present value decrease means I increase. And now we should know by this that the I is never going to be lesser than 12%. It's going to be greater than 12% for sure. That way we just eliminate all this. Okay. Now you have these three options left. Okay. So let's go with present value 13% as our next guess. Okay, so it's going to be the same thing. Minus 24,000 plus 5922, 1 plus I raised to the power minus 1 plus 7486, 1 plus I raised to the power minus 2 plus 18,602, 1 plus I raised to the power minus 3. Okay, equals to so I'm gonna substitute I as 13% and calculate. Minus 24,000 plus 922 into 1.13 to the power minus 1 plus 7486 into 1.13 raised to the power minus 2 plus 18,602 into 1.13 raised to the power minus 3. Okay. So you do this, you get minus 4.5. Now you know this is negative, right? Here, using 12%, it was positive. Using 13%, it's negative. Like I said earlier, you need to find an I where the present worth of I is equal to 0. Now that you know it's positive in 12% and negative in 13%, you know that the I is going to be somewhere between 12 and 13. That way you get the I is going to be 12 to 13%. That's basically your answer. Okay. Now, finally, the last question. Okay, the inflation tax. All right. Yeah, this is pretty bad. Let me see if I can copy this. So I'll first explain what the inflation tax means. So, okay. So the inflation tax is basically the net present worth without any inflation, and it's the net present worth with inflation. Without inflation. To be honest, I don't think he's going to give this one, find the inflation tax, in the exam, because this is basically doing the entire table again without inflation this time. Because here we did the whole thing using actual dollar values, using inflation. See how the 30,000 revenues we took as 33,000, 36,300. All of that is going to be without inflation. I'll just try to do it as fast as possible. Wait, let me also just show the slide. Here, where is it? Inflation tax. Inflation. This is the inflation tax.
I don't
Net
know if he
present worth.
told us, but I definitely don't think he's gonna give it to us because you have to do the whole thing again.
Yeah.
That's at least like
Yeah,
20
exactly.
more minutes. So yeah, it's just good practice, I guess.
Yep. I'll just show the answer. Otherwise, he showed it to us right here. So this was our table when. Let me decrease. This works. Okay. This was the case where F was 10%, inflation rate was 10%. We got this entire table, right? We did all this, find the present worth. Present worth is what we found here. This one. At present worth using 12%, no. Using the MAR, net present worth, using the MAR was 3258. Now you do that same thing. You start the entire table. You do that, but you do this with F equals to 0% this time. There's no inflation. So you see like how we had actual dollar values in the entire table. All this is going to be constant dollar values. See this? It's all constant 30K. It won't take a lot. It won't take as much time as the first table took, but it's still going to take time. And he already told us that the revenues is 30K. So that's going to be same 30K all around. The operating charges are going to be 12K again all around. There is absolutely no inflation. So they said in the question they just gave 12K. Oh. Right here they said operating cost is 12K per year, and you just need to copy that down, 12K. Right? Debt interest, you don't need to calculate it again. That part is going to be same. The CCA is also going to be the same like we calculated right here. So the debt interest would be, never mind. The debt interest would be 2,400 in the first one, then 1,689, then 892. CCA would be 6,000, 10,000, 1,200, and 7,140. Taxable net income is again going to be, should be, he just calculated it. It won't be the same, but he calculated it. What you do again for this is take the revenue minus all the expenses, the O&M, debt interest, and CCA. You subtract that, you get this taxable net income. Okay. Then the income tax, we know it's 40%. Same thing that we did here, income tax 40%. We just calculate the 40% of that. And then you calculate the net income by subtracting the taxable income from the income tax. No, the other way around. subtracting the income tax from the taxable net income. Okay, you get the net income. You just copy those values again here, right? Then the investment again is 40,000 is the same thing. The difference here is the working capital, we're not going to have inflation, right? So all this that we calculated here, 400, 440, it's not going to be there. It's going to be nothing here. And in the amount that's going to be recovered is again going to be 4,000. So yeah, this is much simpler than the first table that we did because there's no inflation at all. Salvage value also is just 5K that they gave us. They gave us right here, where is it? Your life with $5,000 salvage value. You just substitute that 5K. Then disposal tax effect, U3 is same as before. Okay. Yeah, because U3 doesn't depend on inflation again, because U3 would depend on CCA. U3 is same as before, but S has changed. The salvage value has changed. So U3 we had was 16,660. So that's same. So the DTE, the new DTE, I'll just calculate that part. The new DTE is going to be 16,660 minus 5,000 into the tax. That is 11,660.40, which you would get as 4,664 exactly.
Sorry, just to interrupt. I joined pretty late, so I just wanted to know if some of this was being recorded, so I could watch the rest.
Yeah, it
I'm
was.
recording all that.
Okay, so do you know where I could find the videos?
Yeah, I'm gonna upload this one and then I'll send both of them at the same time.
Okay, all this is gonna be under tutor announcements?
Probably, yeah.
Okay, perfect. Thank you.
Yeah, no problem.
Right. Okay, so this is how you calculate the disposal tax effect. Simple, but then it's going to take a lot of time. I don't think he'll give this. Again, the borrowed funds are going to be 20,000 again. That part isn't going to change due to inflation. 926 is exactly what we got previously. A lot of the table is the same, but some of the parts are different. 926, 6637 right here. 7434. It's the same here. 926, 6637. Net cash flow would change because the net income is going to change. So basically the net cash flow, when you add all this up, it's going to change. If you see 58347230, these are not the values that we got earlier. That's the thing that's going to result in a change in the present worth, right? So this is going to change, and due to that, the present worth that we calculated here using the Mars 7%, that's going to change. What was it? Here. Present worth that we calculated here, all this is going to change. You need to do this calculation again to get a separate present worth. Here you got 3258. With no inflation, you're going to get a separate present worth. Let me see if he gave the answer for that. Yeah, he did. Okay. So net present worth without inflation, you get it as 3563. Okay. Using the way he calculated, again, Mars 7%. The way he calculated this is he took these are actual dollars, deflated them. Same thing that we did here.
Those are constant dollars, and you just use 7%.
Yeah, these are right. Yeah. Because there's no inflation. My bad.
No worries.
These are constant dollars, and then just use the 7% MAR. Same thing that we did here, using the present worth here. So you calculate the present worth, and you get it as 3,563. Okay. Less present worth with inflation is 3258. You just subtract them. Without inflation minus with inflation. That's the formula I wrote right here. This one. Okay. And you use this formula and you get 305. That is the inflation tax. That's pretty much it. That was the last question, right? The inflation tax of the project. that is pretty much it for chapter 14. But I'll just tell you guys to read this comments that he said. What he's basically saying in all this is that in the final exam, basic layout of the question is going to be exactly the same like how we just saw it. There are going to be some variations, and the variations would be like, so for example, in this one, what did he say here? The CCA method. We used the declining balance method to calculate the CCA right here. If you guys can see this, use the declining balance method right here to calculate CCA, but it could also be, there's no reason why it couldn't be the straight line method. So that would be simpler, but then yeah, it could be the straight line method. If he said in the question that the CCA is calculated using the straight line method, then we would use the straight line method. So it could be like that, or you see the salvage value, it could be decreasing. It could be based on the present worth. Like if you guys remember the chapter 11 questions, I think the salvage value keeps decreasing metrically. It could be something like that. The salvage value could keep decreasing. You mentioned that here. See, salvage value couldn't be a function. It could be a function of the original price, as it was in chapter 11. So these small changes or variations could be there in the final exam question, but then the basic layout and the way to proceed is the same. Start with the income statement, the revenues, inflate those, get the actual dollar cost, all these. Then you just do all that again. That's pretty much it. Does anyone have any questions? If not, I guess I'll keep a session tomorrow for chapter 11, 5, and 6 because we're already over time. So does anyone have any questions?
I don't have a
No.
question, but like I can just add something, which is
yeah.
Can you go to the depreciation part you did?
Right. This?
Where you no, it was where you showed like the relationship between that and the taxes.
The taxes?
Don't remember.
The disposal tax effect?
I think so, yeah.
Disposal?
Yeah, right there.
This one, right? Okay. Yeah.
So when you did that, I don't think he said this in the slides, but when you depreciate it, you should probably realize this relationship, because like what I think of it as is when you depreciate something, you're kind of reducing how much power you can kind of purchase it with, right? Or like the value of it, and then that is, if that's greater than the salvage value, then it means that you kind of overestimated how much money you have, so you have to kind of pay it back. Like if it's less than the salvage value, then you overestimated it, and then like it's an inverse relationship.
If it's greater than the salvage value, you underestimated it, right?
Yeah, and then the opposite for if it's less than the salvage value. So like it's just easier to think of it like that, as an inverse relationship.
I'll just write the relation right here.
Yeah, probably write the relationship down.
No,
because I don't think he said in the slides, although he kind of put it in like the notes.
I think he mentioned it in the notes. Yeah. So what he's saying is, okay, there's two cases. A, if UN is greater than S, that means that you under depreciated the asset. Did I even spell that right? Under depreciated. I don't know. I think I did. Okay. Depreciated the asset. Okay. So as a result, that caused you to pay more taxes. CRA. You should have. Okay. So that way you paid more taxes, and so the CRA is going to return that to you. CRA will return taxes.
So that's going to be positive at the end.
Yeah. The DTE will be positive. And in case 2, if UN is less than the salvage value, that means you over depreciated it. Okay. The asset. So that caused you to pay less taxes. Less taxes. Then you should have. So you're gonna give those extra taxes to the CRA. Company will pay. Company will pay extra tax, extra DTE amount. CRA. And the DTE would be negative in this case. That is the relationship between the DTE and what is going on, like what the company would pay to the CRA. It is possible that he could ask a question instead of calculate. Like here, he said calculate the DTE, right? What was it? No, this is the
There's another one here.
disposal tax effect in dollars. So he could say how much would the company need to pay, or how much would CRA need to pay the company, instead of asking to calculate the disposal tax effect. So you need to know that it's basically the same thing. We are finding out as the DTE is basically how much the CRA will return taxes to the company, or how much the company will pay the CRA extra. That's pretty much it. I think that should be it for chapter 14. Yeah. Question is basically going to be just like this. Might be some variations in the different calculations, like the salvage value could be decreasing exponentially, or the CCA could be straight line, or the debt interest could be something else, or suppose the operational operational costs, they could be increasing instead of remaining constant at $12,000, or it's constant at $12,000. But it's different because here in these values we got it different because they're just being inflated differently. They could also be, increasing or decreasing. These operational costs, they could be increasing or decreasing.
Like a geometric
The way you need to do
gradient.
the same method, right? It could be anything that we've learned in basically the entire course. Yeah, that's pretty much it. So does anyone have any questions regarding any of this? Right.
Yes.
I don't think anyone does.
I think
Okay,
you're
then.
done for the day, right?
Yep, here.
Alright, I'll stop recording.